And I'll start recording again. Okay, and we're recording now. So this is week 8 of the Wednesday workshop class. Oh, and you might notice a large brown dog at the window behind me. Doesn't like the fact that it's raining and miserable in this part of Sydney at the moment. And being outside isn't nearly as much fun as sitting curled up under my desk. Such are the realities in the COVID world. Okay, just in terms of housekeeping and background, I've been asking people to fill in, take the very short survey to let me know how you would like to take the exam, whether you would like me to issue the questions, or whether you'd prefer to get the excitement of seeing them for the first time when we have our exam, which I think I've put on Moodle, and it's going to be the Monday, pretty sure it's Monday of the exam week. Anyway, look at Moodle, you've got the day there. So it starts at 9 o'clock. Now, notionally, it's a 3-hour exam. I will be making the paper available at 6 a.m. and I won't be asking for you to finish it until 10 p.m. But I'm stressing the 3-hour-ness of it, the fact that it is nominally a 3-hour paper, because that's what it's supposed to be. It's not meant to be something that requires all-day effort from you. You will have the freedom to use more time if you want, so nobody's going to run out of time. Well, except if you end up spending 15 hours and get to 10 o'clock by night and you're still scratching your head. I hope nobody's in that situation. But if you allocate about 3 hours, maybe a little bit more if you're a bit slow typing or what have you, and work out your time accordingly, what that means is that if you are working or have family obligations or what have you, you'll be able to fit it in, whether you do it first thing in the morning, whether you do it during the day, if you can get a bit of time off from work, whether you do a bit in the morning, a bit in the afternoon, a bit in the evening. It's up to you, okay? The paper eventually will have spaces in it for you to include your answers or to write your answers. And so all that formatting and stuff should be kind of in the file. It will be a Word file. Won't be anything fancy out of Excel or what have you, so it should be fairly straightforward. It's just a matter of basically writing the answers in. In terms of how much of an answer I'm looking for, I would recommend you practice or give some thought to how much writing you can do in, well, the time allowed. If we do it as sight unseen paper, there'll be 6 questions out of the possible 11. I will be picking 4 of them. You can pick 2 from the remaining, 7, and go for your life. That's terrific. And that means that you're going to have about 3 hours, well, nominally 3 hours, to answer 6 questions. That's half an hour each. And so if you want to find out how long I'm expecting the answers to be, just think about how much you can reasonably, comfortably write in 30 minutes, half an hour. Okay? And that just gives you an idea. Some people, if you're using, I don't know, a lump of charcoal on a flat rock, that mightn't be a lot of words. For other people, if you're absolutely gung-ho flash typist and can type as fast as you can think, I might be in for reading thousands and thousands of words for every question. In general, though, look at what's in the textbook, look at what's in the notes, augment that for those who are interested in reading a bit further afield with maybe what you find, from reading the financial media or other commentaries or journal articles or, what Uncle Fred has sort of told you. Augment all of that and, away you go. The questions are not unlimited, so it's not like I'm expecting a PhD thesis, since you've got a lot of time. And in fact, for a lot of people, if you write more words, it may not really help your mark, because I'm looking for the answer to the question, not, you know, your version of the Encyclopedia Britannica. And thinking about crisp answering those questions is what we're looking for. Similar thing holds if we issue the questions beforehand. So far, I've got less than half of the class have responded, but the response rate indicates something in excess of an 85% preference for getting the questions early. As I think I mentioned last week, when I have given students this option in the past, that's about typical, you know, in terms of show of hands in a real life classroom or whatever. It seems that there's overwhelming preference for this approach, and generally it works very, very well. I get very pleasing results, you guys get pleasing marks, and there's every indication that you've learned everything that needs to be learned. So win-win-win. So it's terrific. If we do it that way, I'm only asking you to answer 3 questions. 2 of them I will set. 1 of them you can choose from the remaining 9 questions. Now, realistically, if you can write a good and comprehensive answer in half an hour to a question, that's actually about as much time as you really need to think about, or the much quantum of work as you need if we're only doing the 3 questions. The reason for that is that whether it's 3 or 9 or get you to answer all of the 11, what I'm really doing is taking a sample of your knowledge across, you know, the unit. And so that sample, I only need to take the same size sample, whether it's 3 questions or 6 questions. My experience, I'm not sure if I told you guys in this class, but after I've been running this style of question where I issue the questions early in term for quite a few terms, semesters, I actually experimented with one further development where I gave the students the opportunity, say in our case, and just to translate it into what we're doing here. I said, well, okay, you've got to do 3 questions. 2 of them I pick, 1 of them you pick, go for your life, right? I said, however, if you would prefer, you can write on the front of your exam paper that you take the short option, and all you have to do is choose 1 of the 2 questions which I set as compulsory, write 1 answer to 1 of those questions which is set compulsory, and go home. And that meant that my students who were expecting to sit down for a 2-hour exam, as they were in those days, could choose to write 1 question rather than, I think in those days it was something like 4 in the whole paper. Write their answer and go home. And the first time I did it, I thought, oh, you know, this is going to be a little bit tricky. Is it going to give me a representative sample? How are the grades going to come in? Is everyone going to get 10 out of 10, or is it going to be representative? And the thing I found surprising was that the classes that I ran it for, those students that chose the short option, basically to answer 1 question, tended to have the same profile of grades, a little bit higher, but you know, the same general profile as the students who did more answers. And from that, I concluded that if I'm taking a sample, it doesn't matter whether I take a big sample or a small sample, as long as it's a representative sample, it works. It's a bit like, I don't know if any of you guys have got a pool in your backyard. I'm unfortunate enough to have one of these things. And when I take a sample of the water down to get tested to see what chemicals I've got to throw in the thing, it doesn't matter whether I go down to the pool shop with a 50 ml sample or a 2 litre sample. When it gets down and they do whatever they do to it, I end up with the same results. I have to put the same amount of pool chemicals in. And I guess if we use that parallel, whether we take a little sample of your work, as long as it's representative, or a big sample of your work, it's all representative. So it works surprisingly well. And I've come across, and sort of talking about this approach to exams, I've come across other people, colleagues that I've known who have done university courses where something like that was done. Basically, 1 answer, 1 question to do in the final exam. You know it's going to be taken out of, let's say, 12 questions or something. You don't know which one is going to be the one that's going to be selected. and away it goes. Apparently it worked quite well, and my experience as well. Anyway, so that's just background, just to give you an idea of the robustness of the approach of giving you the questions and only expecting a relatively small number of questions. And also just to give you a little bit of a heads up that if we do it that way, you won't necessarily have to occupy, all of your day or even 3 hours of your day answering the question, because I'm simply looking for something which tells me about how good you are with the various topics. One of the other advantages of having the questions beforehand is that it enables you to do, well, especially in this case where it's all going to be online and you're going to be working on your computers and stuff, it means you can pretty much have your answers prepared beforehand. If you do your 12 answers or 11 answers, it means that when it comes to the big day, just a matter of saying, oh, okay, I'll do questions 3, 7, and 10. Pull them down off the shelf out of your computer thing. It might take you all of 10 minutes to finalise the exam for you if you've done the homework. And that has the advantage that you've got the certainty. You don't have to go in with fuss and anxiety and all that sort of stuff. And I get a good indication of what people know. And you should be kind of, my goal is to get you guys to the situation where you know as much as I can get you to learn, so that you're going to be the best people in industry that you can be. I would like to be able to say that my graduates outperform people from other universities. That's what I'm here for, especially if it can be sort of enjoyable for you guys. Okay, so that's what we're looking at, your future basically. Okay, please complete the survey if you haven't done it already. If I don't get enough people participating in the survey, I'm going to be a little bit uncomfortable making the call to do, which I think most people want, which is to have the exam questions early. But as I said last week, I want a clear majority so that I can say, put my hand on my heart when the dean sort of comes around and says, hey, Small, what are you doing sort of giving the questions out early, I'll be able to say, well, that's what the class wants. And I mean, I might have my past experience, but I don't want to impose on something on you guys that isn't clearly in the interests or the preferences of the class. I simply need those answers to come in. So get onto SurveyMonkey. You'll find the links there on the Moodle site. And if you can do that, the sooner you can do that, the sooner I'm looking for at least 80% of the class to come in and give me their results. So at this rate, I expect that will probably give me something like about 70% or more in favour. But at present, I actually have less than a simple majority last time I looked. So I'd really appreciate that. Okay. That's the promo for the exam. We better move into our topic for the day. And to do that, I'm going to move over to sharing the screen. And you guys, it'd probably be wise for you, and you guys are probably doing this anyway, wise for you to download and open up the PowerPoint presentation as I work through. It's a good idea if you've actually had a look through it already. If you've read through it, then that's fantastic. You can just kind of sit back and have a very relaxing couple of hours with me going through this stuff. There's one thing that I do want to point out. We'll get down to one of the slides. We'll see it when we get to it, where there was a typo which has been corrected. So just watch out for that, because it's still on the PowerPoint file, which is on Moodle. I'll be fixing that shortly. I just haven't fixed it yet. I only discovered it when we were going through in class yesterday. Okay, this week we're going to be looking at the cost of capital. In particular, we're going to be looking at a thing called the weighted average cost of capital. This is because, in the last couple of modules, we've been working towards the method, the best method, the discounted cash flow method, of evaluating projects. In other words, the acquisition of capital assets that a firm, an organisation might be considering. Most of the time when we're thinking about firms and so on, we're thinking about public companies. But remember, I've been saying This could also apply to sole traders, partnerships, and individuals like you and me. You can apply this to your own property investment. You can apply it if you are really dedicated to buying a car. It's delightfully flexible, especially what we've done over the last couple of weeks. Okay. However, over the last couple of weeks, we've been giving you all this fancy and complicated mathematics, and a lot of it hangs on the delicate question of selecting the appropriate rate of return, discount rate, hurdle rate, if you want to use that term. Okay. And selecting the discount rate turns out to be one of the big challenges here. It turns out the discount rate is one of the most important variables in your modeling. So if you get it wrong, your model's going to be not looking very good. And so getting the right discount rate, fabulously important. How do you get it? And that's something which right now we're in the delightfully safe and secure area of university land, and so we don't have to do battle with the real world. But when you apply this in the real world, that's when it really becomes relevant. Very obvious. One of the other units that I teach, property investment finance, and for you guys who might be going on to do that unit, you'll find that the major assignment is actually a practical investment appraisal. And when students have done this unit, business finance, and they got all the theory, and that's fantastic, and in that other unit we get you to go through and build a investment appraisal model, a DCF model, specifically, for the assignment, and then they have to decide on the discount rate. And I get an awful lot of mail from students saying, "Oh, can I use CAPM? Can I use this? Can I use that? How can I find this thing? I don't get it from the ABS. I can't buy it. I can't get it from, all of the other data sources and commentators and all the rest of it. It's simply not around." And suddenly they just go, "Whoa, this is actually not as easy as it looks." It's actually not that hard. It's just a bit mysterious. So if that's not a contradiction in terms. Today, what we're going to be looking at primarily is one way of selecting a discount rate called weighted average cost of capital. We've done the capital asset pricing model, which you kind of can use if you're looking at an entire company. But here we're going to look inside the company. And we're going to be working on the assumption that if we know what rate of profit the company needs to produce in order to meet its financial obligations to the various entities that supply funds to the company, then that gives us an idea of how hard the money is going to have to work on any project that the company takes on. Okay, so the weighted average cost of capital is a good starting point, right? And that helps us to actually get a perspective on how the company actually looks at these things. In consulting, I've been in situations where we've actually asked this question, sometimes for very large companies and very large lumps of assets. And one of the big questions that I've sat down in boardrooms with people from organisations like Ernst & Young and so on, and we've just had all these very senior people sitting around sort of, which discount rate will we use? Where does it work for this part of the company? And then we've had to have a really close and practical look at how the company works and really unpick its balance sheet and the profit and loss statement and actually make some decisions there. So this stuff is very, very real and very, very useful if you get it right. Okay, weighted average cost of capital. Okay, I'll get you to read through the introductory slides here. Really, as I've said before, you can read them probably faster than I can recite them to you on class, and you get a far better use of your time. Okay, what we're looking at here is just sort of reminding us of the way that the company gets its capital. Capital is this mysterious word that usually it means money. Oddly enough, strictly speaking, capital is not money. Or when we're talking finance, usually that's what we're talking about. Okay, so here we'll assume capital more or less means money, but working capital and long-term capital, fixed capital, actually are things. Might be a bit of cash in it, but most of it is in things like buildings, machines, computers, stock on the shelf, raw materials kind of in some bin rating to be turned into something else, all that sort of stuff. Okay. Right, just read through these. It gives you a general perspective. What we're really doing is just sort of setting the scene here. And one of the important things is that a company has to get money from somewhere to do what it does. The two major sources of that money is either by borrowing or from shareholders, from owners of the company. And the shareholders, the owners in the company, supply equity. They want a share in the profit. They don't know what profit's going to be, but they simply want a share of what it is. Our creditors, people that lend us money, usually, but not always, charge us an interest rate, and that is fixed whether we do a good job or a bad job, make a lot of profit or not very much. So it gives us a kind of variety in terms of where our money comes from. However, we can go through that variety, look at each part of it, find out how many dollars are coming from it, and what the cost is of each of those components. And that's basically what we're doing here. And by the time we do a weighted average of those costs, which are the cost of capital, what we've got is the weighted average cost of capital. Okay, a few weeks ago, we were looking at how to value shares, and we're looking at the capital asset pricing model, which gives us like a ballpark by risk adjusting and so on. We also looked at valuation of shares by looking at expected dividends divided by that rate of return. So the rate of return often will come from the CAPM, but then by what I call capitalizing, which is this equation here, price equals the expected dividend divided by the rate of return, which is pretty much unique to the company, comes from the CAPM model. Okay, we're able to get the price of the shares. If we rearrange that equation, multiply both sides by R, it sounds like high school maths, divide both sides by PO, we end up with this equation here. So that equation, R equals D over PO, is merely working out the yield which is anticipated. If we say that for our shareholders, our ordinary shareholders, they expect that return, they say, if you don't give us that R value, that yield, then we'll sell your shares to somebody else and we'll go off and get someone others, because we don't like owning shares in your company because your company isn't performing as well as we expect. And that will eventually drive down your share value. And because the dividend is pretty much a constant, the dividend comes from the doings of the company. It doesn't matter whether the shares are worth $100 or tuppence halfpenny. The dividend is coming from the people that are working in the company, using the resources that are in the company to work as hard as they can, produce as much revenue as they can, minimize the costs when they can, and produce a profit. And that gets shared around to people as a dividend. So the D is actually constant. But what will happen is that if this R value is, well, let's go back up to this equation. Dividend is constant. If the price seems inappropriate compared to the expected rate of return, which comes from the risk profile and CAPM, what will happen is that the current shareholders will sell their shares, the share price will go down, and if the share price goes down, it actually rejuggles this equation. That's probably more evident here. Okay, D is constant. If R is too small, what will happen is that in the market, P will end up falling. And if you look at the algebra involved, if the denominator gets smaller, the value of the whole right-hand side gets bigger, and so the rate gets bigger. Okay, that's high school algebra. And that's largely what happens. So in a sense, the expected rate of return, which is believed, demanded, required by the body of people who are likely to buy shares in the company, determines the R, the rate of return. Now, if you're happy with that as a concept, what it means is that your shareholders aren't really simply accepting whatever profit the company is able to turn out. The shareholders are really a bit like the bankers. You go along to the bank to go and borrow, $1 million or something, and the bank will say, yeah, we'll lend you $1 million, no worries at all, 6%. And you know that if you're not willing to pay 6% interest, then the banks are not going to lend you money. Well, it's the same thing with the shareholders. It may not be so obvious, but really the shareholders have got a pretty good idea of what rate of return they expect before they will buy your shares. And so in a sense, the shares have a fixed expectation of a rate of return. And that's the way that the share market works. What this means is that this R value, this R value is really a fixed number or a certain number for a particular company. And so I can say, well, it's not simply a return, it's actually a cost in the same way that interest is a cost. And that's the way it goes into the profit and loss statement. So I can rejig my thinking and say the cost of my ordinary shares is worked out on this ratio, and the ratio is D over PO. Okay. Why am I stressing this? When you download these slides, by the way, the buff color and a couple of the other colors that I've put in here aren't on the file that you get. The numbers or what's written is exactly the same. I'll just put the buff on just to go and highlight a handful of slides. Okay. What I've been introducing here is the way that instead of using the idea of R for rate of return, which we've been using so far, and for good reason, I'm going to start using, I'm going to abuse the English language here. I'm going to use the symbol K for cost. Maybe if I had German parentage, I'd be a bit more comfortable with K for cost. The reason I'm not using C for cost, which is really what is somebody who's brought up in the English language would be likely to use, is that C is often used for other things in our calculations, such as constants and other places. And so K for cost is a nice way of keeping the letter C available for other more important things. And it seems to have come into the traditions, if you like, of finance. And so when we talk in terms of costs of capital and so on, usually we use Ks. Maybe finance people can't spell, I don't know. Okay, from the previous slide, no, I'll just put that, I'll just go back to it. I said this is the equation we want to use. The dividend divided by the starting price at time naught, equals R. R I'm going to stop calling a rate of return, I'm going to call it a cost, and that brings us to this equation here. The cost of our shares is the dividend on our shares divided by the price of the shares. Now this works for ordinary shares, where you get the ratios, the expectations from the capital asset pricing model and expectations. And that's about as far as it goes. It's even more explicit when you get to preference shares, because preference shares have a definite statement of what the dividend is going to be. and from that the market will price the preference shares. So preference shares have a fixed dividend. They have a market price, which you can find from the market. And so they have a cost, a K for cost, which is easy to calculate. So preference shares is probably a little bit easier to work out than ordinary shares, but it basically follows the same mathematics. Okay.
Does the PS on that...
Just speak up, please.
Does the PS on that equation stand for preference shares?
In that case, and as you read through that slide, you'll see that somewhere here.
Oh, preference share, yeah.
Preference shares that sort of talking about in this particular. Okay. But we could have OS there as well. And as we go through the slides, I think we find it being expressed in terms of OS. So I shouldn't say something like the slides on occasions are a little tiny bit tedious, but you know, they're sort of laid out very step by step. I kind of expect you guys, well, I see it as preference shares are simply a special case of ordinary shares. The maths is exactly the same. The only real difference between ordinary shares and preference shares is that with ordinary shares, you have to research a little bit more to find out what the expectation is of a dividend. And with preference shares, the size of the dividend is actually specified on the document, on the share itself. Okay, that's the main difference. There are lots of other practical differences with preference shares as well, but they don't concern us at the moment. So whether it's cost of ordinary shares, cost of preference shares, looking at the dividend for ordinary shares, dividend of preference shares, and the price and so on. So that's kind of where it is. That equation basically works everywhere. That equation is pretty universal for any investment. You know, we're talking more about shares here, but the idea of yield is very common. You know, and it's a ratio of, you know, the profit or the benefit that comes from something, and you've got yields, everything from financial yields, rental yields on property investments, even in agriculture, you've got yields of seed. You know, just how many tons of rice do you get for how many tons of rice seeds? So it's a very universal kind of relationship. Okay. We can do a similar thing. Remember when we're looking at share pricing, we went from the simple capitalization equation, which is the previous slide, and then we added growth into it. We can do the same thing here, where we start off with the equation that we should be fairly familiar with from previous week. We add a G for growth into the denominator, and again we simply rearrange the equation here. Similar thing, you're going to multiply both sides by R minus G, divide both sides by price or initial price, PO, and then subtract add G to both sides, and so you end up with the sign changing. That's might be worth your while as practice, and also to help you learn it and memorize it. Actually do that transformation. Just get out your mathematician's hat, do a bit of algebra, take that equation, turn it into that one so that you're totally confident. And then the last step is going to be a little bit of sleight of hand, where we're going to turn R into K. And that basically completes the change of perspective, if you like, from being preoccupied with working out the price to being more interested in the component as a part of the cost of capital. Okay, and here we're using the subscript OS to denote ordinary shares, and that's the more complete equation for the cost of ordinary shares for a situation where we're expecting the ordinary shares to grow at a stable rate over time. Okay, so that's the equation there. Because preference shares have a fixed dividend, you don't have growth. And so the G doesn't really apply in most cases. Some preference shares do have the capacity for participating in the extra profits. But that's just a matter of looking at the way the preference share is written. And we don't need that complication at this stage. Okay. We've also got the cost of ordinary shares, not just coming from the current price and dividend expectations, but also from the CAPM model. And so here, those of you, you'll probably recognize that KOS could have been ROS, which was the more familiar presentation of the CAPM equation. Okay, the return on the risk-free investment, that's usually the government bonds, plus the beta for what we're looking at, multiplied by the gap, the difference, the risk premium, which is the difference in return between the market, the All Ordinaries basket of shares, and the risk-free rate. That's just the CAPM. Okay. There you go. The red is worth remembering. All we're doing there is a bit of a review. Okay, overall cost of capital. When you look at the cost of capital, we'll start off by talking about the way that companies have some debt. Often they'll have different sources of debt. They'll have capital, like equity capital, and sometimes there's different sources or species of shares, of equity. We tend to talk about preference shares and ordinary shares. Don't take that to mean that there's only two types of shares, because there are other varieties of shares as well. There's different varieties of preference shares. There's also different types. Well, there's deferred shares. There's different varieties of participating, non-participating ordinary shares. There's a bunch of different, if you like, sort of subspecies, having to do usually with either the way that the income is taken or the participation in control. Right. We're looking at using the CAPM. I think that speaks for itself. This is an important slide. And as you read through this slide, the important point that it makes is one which I don't think, at least in my experience, is really adequately explored. Probably because there are so many possibilities that it's hard to have a simple one-size-fits-all solution to it. Maybe some companies do run some sort of risk analysis through their company, but what we want you to think about is the way that, so far we've been talking about the sources of capital. That's mainly what we're talking about today. And we can think of those sources of capital a bit like a miniature CAPM situation, where you've got different risks and different returns. You know, generally your debt is going to come at a lower interest rate than the yield that your shareholders are going to expect in order to support the prevailing share price. What does that mean? It means that if I buy a share in BHP, I expect, because I'm accepting the risk of the BHP company, that I'm going to participate in the risk, and therefore I should be participating in a higher level of return. If I'm lending money to BHP, say buying a BHP debenture, because there's a far less risk involved in owning a debenture, I will accept a lower rate of return. If I'm the bank lending to BHP, I might even be more secure, and I might be content with a lower rate of return, a lower interest rate, than either the debenture holders or the shareholders. And so just within one company, in terms of the capital structure, you're going to have a variety of risks and returns. Make sense? Okay. Curiously, on the other side of the balance sheet, on the asset side of the balance sheet, some of your assets are going to be very secure, stodgy even. For instance, for most companies, most like banks or the NRMA, insurance companies, what have you, they might own a bit of real estate. They might own their head office. Companies like shops, Grace Brothers, David Jones, the Kmart. Their business is selling things, and it's on their working capital, their inventory, that they make most of their money. So they're turning it over pretty quickly, and they usually make a fairly, useful rate of profit, gross profit on that. But they might also own the shop. Now the shop's going to be sitting there rain, hail and shine, and so they'll usually end up with a lower rate of profit from every dollar that they spend on their shop compared to every dollar they spend stocking their shelves. And so from that perspective, it's like on the asset side of the balance sheet, you've got another CAPM model kind of lurking in there with returns, rates of profit, rates of contribution to the profitability of the company, and risks. The shop for Kmart is very low risk. It's going to be there, rain, hail or shine, and sure enough, somebody might graffiti the wall and it might cost a little bit to maintain it, whatever, maybe replace the roof every now and then. But generally it's there, it's there, it's there. And because it's real estate, if it's there in Brisbane or Melbourne or who knows where, year by year, its value is probably going to creep forwards regardless of what Kmart are doing with it. By contrast, the inventory, what's on the shelves, you've got the possibility that, they might buy 1 million, bright orange socks or something, and then find that nobody wants to buy them because wearing bright orange socks has gone out of fashion. And, they might make much profit on those. Or maybe they might be selling bananas or something and they all go rotten on them. Maybe they're selling things in such a way that it's easy to shoplift. There are a whole lot of reasons why the inventory is high risk, but is also contributing to a high rate of return. Okay, in this slide, what we're doing is we're saying, well, actually, you can use that to analyze the inside of your company to say that different assets have to work harder or lighter depending on their risk profile. Your real estate really doesn't have to work as hard as your inventory because it's low risk. Even if Kmart was to close tomorrow, they could sell their shops pretty much because they're shops. And, they'd find a good buyer. If they close their shop tomorrow and tried to sell their inventory, who wants, stock from a shop that wasn't able to sell them? People are going to want a fairly huge discount. So, the inventory is high risk. Okay. Now, when we're looking at it from a financial performance point of view, the problem there is that while we can talk about this stuff conceptually, and it's important for you to be thinking about it conceptually, actually analysing it down to the point where you put numbers on it, like assign beta numbers, for Kmart's real estate might have a beta of, 0.4, and its inventory might have a beta of 2. What's unit beta for Kmart? Well, we use the All Ordinaries to give us our unit beta in the CAPM model, but we've got all these big questions about calibration and stuff, and financial managers usually just aren't up to that kind of allocation. So that's really what we're saying here. There's another aspect to this. We'll get to it later on, but just to flag it, and that is that in a sense you can sort of see the rates of profit filtering down through the company. Kmart has to make a certain amount of rate of profit in its shop at wherever, Brisbane CBD or the back of Blacktown in Sydney or the Ballarat store or wherever Kmart happens to be in some regional centre. Okay. They have to make a certain amount of profit because, as well as making profit for that particular part of the enterprise, which can be considered as a project, it also has to carry the general overheads of the head office of Kmart. And so by the time you start off with a high rate of profit per shop, and then you take off your overheads, you're going to end up with a smaller rate of profit for the organisation as a whole, which ultimately is what your shareholders get to see. And so there's this kind of cascade of profit levels, of rates of return as you go through one company. And when we're thinking about, let's say for a project, we'll stay with Kmart as an example. If the project is opening a new Kmart shop at, think of a place that doesn't have an Emerald. Now, I'm not an Emerald or Mackay. But let's imagine there's no Kmart in Emerald, and Kmart are thinking about putting one up. What they have to do is say, what rate of return do we need in our store in Emerald in order to be able to filter through the organisation and return a benefit to our shareholders? That's kind of one of the lurking questions with this. Okay, getting a little bit ahead of ourselves. But at this point, I simply want to get you thinking about the way that within the company, when you look at different parts of the company, whether it's the new photocopier or it's the new Kmart at Mackay or Coonabarabran or wherever it's going to be, we've got to solve this puzzle. To do that, it's useful for us to unpick, to really explore the geography of our balance sheet. Now, with this, it's not looking very good. There you go. Company's overall cost of capital. What I've been talking about so far is really getting us to look a bit more, I might say critically, or in greater depth, looking at the way that the balance sheet works. Come back here. So we're looking at this thing here. I think previous week we looked a little bit more at the profit and loss statement. Here we're going to be looking at the balance sheet. It's useful to think about the balance sheet as its component parts. What's on this example is fairly just broad brush representative. I'll just go through the way that it works. Okay. The company gets its capital from various sources, mainly debt and equity. The debt tends to come in a number of fairly standard buckets, but they each have a particular characteristic from the point of view of cost, of financial analysis and budgeting. Okay, we've got current liabilities and we've got long-term liabilities, like long-term, not exactly fixed, but sort of liabilities, debt that is typically lasting over 12 months. As we go through them, there are two types of current liability which are worth being aware of. Accounts payable, in other words, your creditors, people from whom you've bought things, usually on something like 30-day terms, what have you, a monthly payment. And you also have accruals, things like unpaid leave for your employees, other accrued obligations. You've done accounting, so you understand those distinctions. The important thing about this is that your creditors and your accruals are actually creditors, but they're very unlike all of the other creditors you're ever going to have. And the reason is that all of the other creditors, let's say if there's a mortgage here in long-term debt or short-term debenture or whatever, they're all going to be costing you an interest rate, whereas your accounts payable doesn't cost you anything at all, and your accruals likewise. They haven't actually matured into actual liabilities yet. So they're free, And you'll notice that in this example, your accounts payable is actually a significant part of your capital structure. Okay, not the whole thing, not the majority, but a significant part. And the reason for that is that if you can get money to work for you that doesn't cost you anything, obviously you're going to be a lot better off. So it'd be far better to have a lot of accounts payable and a relatively small mortgage on your building, simply more profitable. Okay. Notes payable, which is short-term borrowings, which will come with an interest rate. So that'll be 30, 60-day debentures, perhaps a bit of overdraft that'll come with an interest rate. But that is kind of churning over all the time. Doesn't mean that because it's short-term, it'll get paid off and you won't see that 21,115 next year. It's just that whatever it's going to be next year, might be a little bit more, it might be a little bit less, but it'll actually be different dollars because these notes will have been repaid and others will have come. Long-term debt tends to be debt which is contracted for more than 12 months. The most common there is real estate mortgages. So they're fairly fixed. Then we've got ordinary retained, we've got shares, whether we've got ordinary shares, preference shares, deferred shares, are all contributing to our capital as equity. We've got this other creature, which becomes a lot more important in finance than you find it when you're doing bookkeeping and accounting. That's retained earnings. Often retained earnings is kind of glossed over when you're doing accounting, but it's actually very, very important. What are retained earnings? They are previous profits that haven't been distributed as dividends. They have the effect of increasing the amount of useful capital that the organisation has available to itself. So if the company didn't have any retained earnings available, it would have to sell more shares. And in this case, to have the same capital structure, it would have to sell an additional $512,159 or thousands of dollars, whatever the units are, of shares. And that presents complications, which we'll be dealing with in a later week. The advantage of retaining your earnings, oddly enough, is it's simply a lot simpler. You don't have to sell more shares. Your shareholders usually see that reflected in the appreciation of the value of their shares. And so you get the money available, your shareholders get recognition of that because of the prices that your shares are going to be trading for on the stock exchange and so on. Okay, that's that side. That's really what we're interested in with our weighted average cost of capital. We're going to be looking at each one of these, looking at what its cost is, and simply doing a weighted cost for each one of those components, a weighted average. And as I said, the nicest one is the accounts payable and the accruals, because it costs you nothing. Let's go back to regular size. Good idea to read through that. Just as background, a lot of you, especially if you're keen on the accounting side, most of that should be pretty familiar. But the important thing is the way that we're focusing what we're actually looking at. Here, we're far more interested in cash flows, as you've already seen, and we're looking at market values rather than book values, because finance is a very practical perspective. Now, I'm just going to change the graphics, if you like. We start off by looking at this graphic, which had all of the names, if you like, of the typical boxes that you find in the balance sheet. This slide is very, very useful conceptually. You'll notice it doesn't have nearly as much information on it, but as a concept tool, really useful to have in your head. Okay, this top part, often referred to as the accounting equation. I hope you have already seen that or familiar with that accounting equation notion before. accounting equation, assets equals debt plus equity, liabilities plus equity. Okay, if you have that in your thinking as part of the way that you approach all this stuff, it's just an awful lot easier to conceptualize. Okay, assets equals liability plus equity. Really, really easy, but a very powerful schema to be aware of. Okay, all of our projects tend to be in this area here. When we're talking about projects and the valuation of projects and all the stuff we've been doing over the last, especially the last couple of weeks, is all in terms of buying assets. Typically, we've been talking about capital assets, but it can also apply to current assets as well. A practical topic in management finance is inventory control. And you think, well, what's a finance manager got to do with inventory? Well, yeah, we're not really interested in what sort of cans of soup are sitting on the shelves in Woolies, but we are very interested in how much money we're sort of spending on the cans of soup and how quickly they're turning over, and we can do markup policy and all that sort of stuff. And the finance manager is very interested in all of those questions. Okay, so finance is not only limited to big issues like buying subsidiary companies or jumbo jets or new branches for your business in Dubai or something. Okay, lower diagram. We've already got this liability and equities, debt and equities, which we were talking about previously. That gives you your capital structure. Over here, you've got your asset breakup, largely between long-term assets or fixed assets and current assets, but also assets can include things like subsidiary companies, which are not exactly a physical thing. It's not exactly the head office building or a computer or a bread making machine or something like that. It can be another financial asset, another financial entity. Okay, these are things we tend to be evaluating, but we've got to make sure that we meet our obligations to be able to pay our cost of debt and also our expected return on equity, and that's pretty much what it is. Okay, I'm noticing we're up to 3 o'clock. Might take a break here. We'll take 10 minutes and you can go and have a coffee, think about what we've done so far, and we'll come back and continue in 10 minutes time, so about 3:10. Very much. Excellent, I appreciate that. Okay, let's carry on. This is really just restating the issue that I think I stressed beforehand. Looking inside the company and doing like a CAPM inside the company, while you can conceptualize the company in that way, actually quantifying it, frightfully tricky. Although you can have a stab at it, you just can't have a stab at it in the way that you can do it, shall we say, definitively, based on evidence and numbers and all that sort of stuff. And a lot of people make decisions on that basis. They just scratch their head, use a bit of experience and say, oh, I think sort of 16% is the right number for, the discount rate for this part of the company.
Yeah. Would you like to share a screen, sir?
Oh, now that would be really handy, wouldn't it?
Yeah. All right.
How's that?
Much better.
Okay, great. Overall cost of capital. We're really looking specifically at that point there. Okay. Good to be just aware of it, right? Okay. What we're leading up to is this equation here, which is no more than a fancy presentation of a weighted average. Okay. And while there can be any number of Xi's and K's, they really break down to those components that make up debt and those components that make up equity. And so it's really an accounting exercise. It's not fiendishly difficult. It's just a matter of working out the cost to allocate to each part of the capital structure. Okay. I think we can go through that. read that. Cost of debt, read that. Okay, let's go down. Okay. For the various parts of your liabilities, your interest-bearing liabilities, which is your short-term, long-term loans, where you do have an interest rate, your interest rate is going to be specified. And so you've got the interest rate which you can work out, and you can calculate the quantum of the loan outstanding. A little tiny bit tricky if you've got like a principal and interest, a debt foncia loan on real estate, but it's all calculable. And at this level, all we have to do is say, yes, we've got to work out how much debt is out there and what its interest rate is, and we just apply that to our weighted average. There's a tricky part with debt, not really tricky, but just one extra little wrinkle, and that is the multiply by 1 minus t, where t is the tax rate. And the reason for that is that debt interest on your debt is tax deductible. And so if you have to pay $10 or $10,000 of interest in the year, and your rate of tax is 40%, what it means is that for every dollar of interest that you pay, you get 40 cents as a tax deduction. So you're really only paying 60 cents in the dollar for your interest bill. And so your cost of debt is not as high as you thought it was. Not that we have interest rates around 10% at present, but let's imagine we did. If K, the pre-tax cost of debt, the interest rate, is really what K debt pre-tax really means, is a fancy name for interest rate. If let's imagine K is 10% and you've got a tax rate of 40%, what you've really got is 10% multiplied by 1 minus 0.4, which is 6%. Okay, very simple, but it's a concept which is worth your while knowing. What that means is that every dollar you get through debt got the advantage that not only does the bank typically expect a lower rate of return, interest rate, than the shareholders do, because they're more secure. In addition to that, from the company's point of view, the company doesn't have to eventually pay that much for it anyway. So if the shareholders are wanting 15% and the bank is wanting 10%, but after tax, the bank's really only taking 6% from you, you've got this big gap between the cost of equity at 15 and the after-tax cost of your debt, which is only 6. You sort of see the mechanisms going on there. So the tax deduction aspect of debt is really important. Okay, you can work through the worked example, and that's very straightforward. Cost of debt. Okay, we've already done in other classes the effective annual rate when we've got compounding periods, which are, say, monthly, which is the most common one, maybe biannually for debentures, but just simply adjusting, and it's not really worth at this stage going through an example of that. However, we've got one, so by all means, look at, work through that example. Here we've got 30% tax, we've got recurrence interval, we've got biannual interest. So it starts out looking like a 14% cost of debt, ends up after tax and after you work out its annual equivalent rate of only 10.14 a bit percent. Okay, that's work. Just check that with your calculator. Always a good idea, but that's about as hard as it gets. It probably looks more difficult. Just after I said that's as hard as it gets, here we've got, working out the bond pricing and so on. Again, it's just an application of the bond pricing formula that we've used in previous places. Okay, that's fine. Let's get on to cost of equity. Okay, we've already covered most of the concepts behind there, both in this class earlier on and also in previous classes. We're looking ultimately at a weighted average of the different types of shares, and I've been sort of stressing the way that there's a number of different types of shares. We're going to look at two in particular, ordinary shares and preference shares, but just be aware that in the real world there are other types of shares as well. But if you can get your head around ordinary shares and preference shares, then you got the other ones, you'll be able to fit them in, and we're not worrying about them in this unit. Okay, with ordinary shares, we've actually looked at three ways of ending up with a cost or a rate of return for ordinary shares. We've looked at the CAPM model, which is very important, at least conceptually. We've done work with the constant growth, that's D over R minus G, to work out the price of shares, and that's fairly robust, and it's often an easy one to evaluate because you can look at the expected dividends, especially if you just look over recent history and the general profile of the company. You've got the price on the stock exchange if it's a listed share, and the only real wrinkle is making an estimate for G, for the likely growth. And again, you can use history and you can use the general expectation across the economy. So for instance, if you're looking at, stay with the BHP shares, if they've been growing at a particular rate, you do your homework and you get information from the stock exchange, what have you, to see what BHP has been growing like for the last 5 years. You know, next year, not really an easy one to do because of all of the corona craziness. But if we had business as usual happening, then we'd probably be able to say, well, if the pattern of growth in the past has been sort of such and such, then it's probably going to go off into the future. Not so difficult to do. You may get it wrong, and other people might have a different view, and that might make it either easier or harder to buy or sell those shares. But the calculation for any particular individual is not very difficult. Okay, there's constant growth. We've introduced the, well, what's being referred to here as the multi-stage growth dividend model, but basically that pattern that was in those questions in the assignment 5.2, 5.3, I think, where we looked at the way that you have this supernormal growth in the first stage of a young company. These days, startups, venture capital, that sort of thing is becoming more important. It's kind of gathering more attention. And so that supernormal phase is, you know, people are putting more focus onto it. Okay, but basically three models. These 2 and 3 are real variations on the same idea, just looking at different situations for companies. Okay, using capital asset pricing model, you should be getting sick of seeing this equation. And we're going to substitute K for, as we rearrange it. Hang on, as we go. Practical issues, talking about treasury securities, we're really talking about long-term government bonds. And in Australia, we use 10-year government bonds. So we talk about the bond rate. You can find that on the Reserve Bank of Australia's website from their statistics. So it's a very easy number to look at, and you'll find that the return on 10-year government bonds, you know, you can look at how that's been going so historically, which is a little bit scary if you look at what's happening to it today in the light of your economic theory. Okay, long term, okay, read the rest of that, that's really economics. Cost of equity. Important point is probably this third one, the idea of valuing using comparable companies. And that is a very practical issue. doesn't give you the answer necessarily, but it gives you the method. Okay, if you're brewing beer, then you can get an idea of what your company should be worth or how it should be performing by looking at other beer brewers, preferably other beer brewers that are operating on a similar scale to a similar kind of market. And so perhaps, I don't know the ownership patterns with the brewers in Australia, but conceivably Carlton United might be doing what they do down south of the Murray, and 4X are doing what they do sort of north of the Tweed, and they're going to have comparable performance, perhaps comparable size of businesses and so on. And so that's a good way of estimating where you fit on the CAPM model, where you are in terms of risk, and therefore your beta. Okay, read through these, it's useful. Background, practical background. Okay. The important part here is the very lowest part of this slide. It's really a practical example, and I think working through that with a calculator, you'll find it easy to have that satisfying sense of getting the same numbers as what's on the slide. By all means, do that. Okay, move on to constant growth model. Constant growth model, this is an easy equation to remember, memorize. And what we're doing is rearranging it. The cost, which is R here for return, is being rephrased as cost. What we've done is simply rearrange that equation. You'll notice that there is a plus sign kind of inserted there in the slides that you'll download off the Moodle site. That might be a minus, so just a little bit careful. There's a typo on that, and so that plus sign is the correct one, and you'll notice that in other slides and in the textbook and so on, it comes in as a plus. And again, that's the answer, that's it. Okay, we'll bring that back down. Okay, it's simply saying what we've already been talking about. This is a worked example, nice and straightforward. Again, run this through your calculator and you should end up with 13% kind of popping out. Okay. One important thing to notice is that it's what you see is what you get here. The after-tax cost of equity is equal to the before-tax cost of equity, simply because you don't have any adjustment for taxation. Nothing going on. Okay, when we get to the multi-stage, or what's here being called the multi-stage growth dividend model, it's really simply a matter of solving that more complicated cash flow diagram for the rate of return. And the best way of getting to that is in this next slide, which kind of, you can go back to where we were doing this in terms of share valuation for the startup case, for the case where you had the supernormal growth rate in the first few years. That's exactly the mathematics that we were looking at. Here, we're interested primarily in the cost. And so here, we've got KOS, which is the cost of the shares, the ordinary shares. And it's kind of featuring here, rattling through the equation. Here, this diagrammatic presentation is simply expressed in a single equation. That's exactly the equation that you used when you solved question, I think it was 5.3, 5.2 or 5.3 in the assignment. Actually, this diagram is really handy for conceptualizing what happens in that case. I don't think we've had a diagram quite as clear as this, certainly for question 5.3. I think some of you might remember that when we got to that question, people were asking, when does the constant dividend come in? At what point do you discount or reduce it back to, and all that sort of stuff. Here, the key thing is that this pattern of dividend performance starts at year 4, the end of year 4. It's actually being discounted back effectively to the beginning of year 4, the end of year 3. And the fact that this pattern is reduced to this point in time, the beginning of year 4, the end of year 3, explains why this part of the equation is the way that it is. I'll just blow that up a bit so it's kind of easier when we get it recorded and put onto Zoom. But you'll notice down here the exponent is cube. Okay, so you're discounting it for 3 years, even though the constant dividend starts in year 4. And so even though this constant dividend starts in year 4, you've actually got to discount it back to a year before. And so if this, if you like, the constant growth period is actually year 1, and 2, 3, 4 off to infinity, you've got to reduce it back to year 0, in the same way that all of our present value exercises are all reducing back to present value, which is time 0. For this part of the dividend pattern, time 0 actually represents 1 period behind. Just give some thought to that. Once you get your head around it, it's kind of pretty straightforward. You could almost, instead of having this arrow coming all the way back here, you could actually have it coming back to this point here. You could have the arrow coming down across to end at that point there. And at that point, it becomes obvious that the discount factor is 1 over 1 plus k cubed, which is what you got there. Okay. Right. Which method do we use? Largely, the method is determined by the data. If you've got the sufficient information to be able to do it using the valuation approaches, the constant growth, what have you, calculations, then that's all good. If you've got information available to you that enables you to do it using CAPM, then that's useful. It's generally considered preferable because there's more, if you like, confidence in the CAPM model. I don't think it's really a hard and fast answer which is better. I think it ultimately comes down to the quality of the data and the confidence in the data, really. Although here we're saying that most people use CAPM. Yeah, okay. Most people might. Whether that's the right answer or not, I think it's still up in the air. Okay, that's ordinary shares. So we've done ordinary shares, and we've said that there are 3 ways of doing them. Preference shares are a little bit more straightforward because there's less estimation. You've got the dividend, you've got the price which comes out of what the market is paying for them, and so you simply have a very simple relationship. Okay, with preference shares, yep, that's just a worked example, quite straightforward. Another one. Okay. The weighted average cost of capital is the weighted average cost of debt adjusted by 1 minus t, plus the weighted average cost of equity, just as it comes. So that's a fair presentation of the equation overall. I guess I'd probably prefer some indication that this debt part could be a lot more complex than simply one item for X and K for debt. And likewise, the share part can be more complicated in practice, but it kind of gives us a fairly clear indication there. Okay, just look at an example. If we work through this example, just got to go through the steps, if you like. We've got, in this example, we've got debt, ordinary shares, which is referred to here as common stock, and we've got preferred shares, again using what's probably more the American terminology, preferred stock. And we've got numbers. First thing we're going to do is we're going to work out the total value of each of these. How many dollars does the company have available as a result of each of these components? Then we're going to work out their costs, their Ks, and we're going to do a weighted average. That's what we're going to be doing. Okay, let's work through the example. Okay, here we've got simple multiplication. Let's go back. We've got 3,000 bonds at $945 each. And here we've got 3,000, that's the number of bonds, times 945, which gives you 2.8 million. We do a similar thing for the ordinary shares, the common stock, and for the preference shares, add those together, and we get $8.8 million. That's fine. Now we're going to work out what percentage of that total 8.8 million each one of those components represents. So we're simply going to divide the amount of debt, the 2.8, by the total capital, 8.8, and that gives us 32.09%. Now do a similar thing for the common stock, the ordinary shares, 5.2 divided by 8.8 gives us 58%, and the same with the preference shares, 800,000 divided by 8.8%, which is a little tad under 10%. Okay, so there are our weightings, the importance or the significance of those three sources of capital. Now we're going to work through and work out the costs of debt. So for the bonds, if they're annually, that's easy. 6.5% is 6.5%, too easy. Common shares, the ordinary shares, we use the equation we've been doing. That's a fairly straightforward example. You should be able to work that out in your calculator and get 12.5% for those. And likewise from preference shares. The preference shares, we have a price of $80. We've got a dividend expressed there, $6 over 87.5%. So we've got three costs. On the previous slide, we've got three weightings, and we simply do the weighted average. With the addition that before we do our weighted average, we adjust for tax for the debt. So the debt starts off at 6.5%, but the after-tax cost of debt is only 0.7 of that. And you basically run that through your calculator. And I invite you to run it through your calculator. And again, that leaves you with the delightful experience of having 9.5% come out of your calculator. So run the numbers through these. The more of this you do by pressing the buttons yourself, the better it actually gets into your head. Okay, another example, which we don't, hang on, example 2, that I'll let you go through in your own time. Get you to read through the notes. They're just kind of background points to keep in mind. I'll let you do those. Most of that is already been done. Got an example there. Again, working through these is really good for review and for your learning. Okay, I want to come down now and look at a bit of strategic issues and sort of background things that are worth keeping in mind as you approach using this. Read through yonder. I've already spoken about this pretty much at the beginning, right? Within the organisation, you've got the difficulty of ascertaining the risk loadings for your different assets. It's important for a company to have that portfolio, if you like, of different risks in their assets, because I think that contributes to the overall robustness. As an example, there was a period now about 30 or 40 years ago when a lot of organisations discovered, like the example that I was telling you about with Kmart, that the dollars that they were spending on inventory, on their stock, were working a lot harder for them than the dollars they were spending on their real estate. So Kmart was thinking to itself, yes, well, every dollar I spend on stocking my shelves actually turns into a pretty substantial rate of return, a gross profit. However, the yield on my real estate earnings is relatively stodgy. And so what do you conclude from that? Well, Kmart saw itself as a retailer, not a property investment company. And so its conclusion was, well, if we can get rid of our real estate assets and put more of our available capital into our inventory, then we're going to improve our bottom line. We're going to end up with a more profitable arrangement. Okay, sounds like a good idea, and a lot of companies did it. To the extent that now everyone from retailers to banks to all sorts of organisations, the government even was in on this game, and it appeared to be a good idea. And the argument was that Kmart is not a property investor; it's a retailer, and therefore by focusing on using its capital where it's got the skills, it's going to give you the best result. In good times, that works really well. In bad times, it actually has a similar magnifying effect on the outcome on your bottom line. What do I mean there? If Kmart has, let's say, 20% of its assets are real estate, 80% is inventory. It's probably going to be a little bit of other stuff kind of in around the sides. But let's imagine that's kind of the breakup. In the good times, I prefer to have no real estate and all inventory, because on every item of inventory, they're making a greater rate of profit because they're turning it over really quickly. They kind of got their marketing sort of worked out, all that sort of carry on. But they don't have to pay rent. And so in good times, they're thinking to themselves, oh, I don't mind paying rent, because if it means I don't have to have these millions and millions of dollars tied up in my real estate, I'm able to put more stock on my shelves, spend more on advertising, make more money. And so it multiplies the upside in the good times. However, you get to something like the global financial crisis in, what was it, about a dozen years ago, or now what's emerging with the corona problems we're having. What happens when Kmart goes through a bad year and for whatever reason their stock, their inventory stops turning over because shoppers are not coming in as much and they're sort of wearing masks and hiding away, and they've got to keep sort of 1.5 meters away from each other, so there aren't many people in the shops, and they're only kind of going out when they really have to anyway. So all of a sudden, Kmart's revenues are down. Because they were used to using their dollars very efficiently in their inventory, which was magnifying their profits, okay, when they let go of the real estate assets, all of a sudden they didn't notice that, like in the good times, because the fact that now they're paying rent simply means that they had more capital to go and put in their inventory. When things go really slow, imagine what happens when you've got a shop where you've got no customers. If you own the building, the shop yourself, that's fine. You just sit there and wait for the customers to come back. However, if you're paying rent because you've sold your shop building and you're kind of leasing it back from some third-party property investor, when the customers stop coming, not only do you lose all of that, exciting edge of profit, but because you've still got your rent to pay and maybe your wages, suddenly your company is really hurting. And it's because you've been exposed to the situation where your fixed cost, your rent in this case, is actually quite high. And so this strategy of getting rid of all of your low risk, low return assets has the potential in slow times to really magnify your exposure to loss and failure. Okay, that's what this slide is telling us about. The way or the idea that companies in their balance sheet amongst their assets have effectively a portfolio of assets that offer different risks and returns means that potentially the discount rate that you should be using for these different assets should be different. You worked out your weighted average cost of capital. Let's say it's, think of a number, 12%. Right? It may be that you should be using 15% on your inventory and maybe only 8% on your real estate, because the 12% and the 8% better reflect the relative riskiness of those two assets. And this slide is getting us to think about the way that when we don't apply that risk adjustment inside and simply using our WACC as the hurdle rate for everything, you end up making the same decisions that lots of companies, and I've mentioned the banks and a lot of the big retailers, made 20, 30 years ago, more like 30 or 40 years ago, about 30 years ago. And what it did was it basically magnified their exposure to downside, really because they were using the wrong net present value. And so what we're advocating in this slide is that you should consider adjusting your discount rates within the company to reflect the nature of the assets that you're looking at. That's illustrated graphically in this slide. And this slide is meant to illustrate what happens when you apply the wrong discount rate to some part of your balance sheet, mainly to the asset side. If you use the one discount rate all the way across your balance sheet, what it means is that your high risk assets, let's say your inventory is a high risk asset, because you're using a discount rate which is too low, because you're using, in the example I gave you, like 12% as your discount rate, but really your inventory should be performing with a 15% discount rate of return performance, right? You'll actually be accepting projects or maybe lines of inventory or business plans to start a new shop or something, tested at 12%, where the project stacks up, but because it really should have been this high level, the 15%, the thing's a dog. It's going to actually give you an exposure to loss, right? So the right-hand side of this graphic is meant to show the situation where implicitly you've got some high risk asset, okay, project. But because you're using this lower than appropriate hurdle rate, discount rate, then you're going to accept it, and that increases your chances of making a loss. Conversely, if you're using your 12% and you're using it on some part of the organization which only warrants a lower hurdle rate, discount rate, because of its nature, its contribution to the company is less risky, and it has the effect of moderating the overall risk profile of your entire organization. By rejecting those projects, then you're again exposing yourself to problems, because what you're really doing is sending your company into a more risky environment. Okay, so you're rejecting, say, the decision to own your own real estate, which I'm claiming has got lower inherent risk than your inventory, and you're tending to be putting money into the high risk assets, which might be adventurous R&D, inventory, one of a number of things. Okay, both of those things are going to adversely affect your bottom line, and both of them are going to be felt. When, like, the risk card, the joker, really becomes relevant. Very, very dangerous. Okay. Oh, right. Read through. A company's weighted average cost of capital should be used to evaluate the cash flows only if the systematic risk of that project is the same as for that of the portfolio projects that currently comprise the company. Even then, not totally accurate, but I think it's intending to get that idea that the WACC, the weighted average cost of capital, is appropriate if the project you're considering has a similar overall profile. Like saying with a Kmart example, if I'm saying that Kmart shops are made up of two things, the real estate plus the inventory. Inventory is high risk, real estate is low risk. If you're thinking of starting a new Kmart out at Dubbo or wherever, and you're thinking about going in and buying a shop and stocking it, the project of its nature is similar to the other projects that make up the rest of your chain of retailers. Right? Because it's got the low risk and the high risk in roughly the same kind of proportions as you find it everywhere else. In that situation, it's appropriate to use the company's weighted average cost of capital as your discount rate. It's also relevant when you're looking at the financing mix. Now, this is one which is commonly misunderstood in the property area. It's not uncommon for property investments to be compared with other investments, either other properties or other forms of investment, and ignoring the fact that their capital structure is different. The financing mix, to use the terminology here, is different. Real estate often relies on high levels of debt. Now, the fact that you're using high levels of debt really means your financing structure is different. The risks to the owner are different, because while debt has the capacity to magnify your profits in good times, it simultaneously has the effect, the risk of magnifying your losses in the bad times. Okay, and so considering your capital structure, your financing mix is really, really important. Okay, just read through yonder for alternatives, and that's, I think, very practical recommendation. Just go through this. I think there's only just a couple of slides to go, and we're just about finished. I think that just about takes us out. Yep. Some references that you might want to look up. Yeah, okay. Yeah, just about takes us out. Are there any questions to finish up the morning or the afternoon?
No.
Okay. Fair enough. If you haven't done the survey, please get on and do that. As I say, once I get a clear indication, once I've got sort of a clear majority of the class having completed it, that doesn't mean that because I'm only looking for a majority of the class, I don't want you to. But please get that done, and that way it'll be sort of fair to everybody, because we'll be able to make a final decision there, which I think people are looking forward to. Okay, without further ado, I'll let you go. Thanks for your attention, and we'll see you next week.
Thank you very much.
Yes, sir. Bye.
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 Bye.